Companies with the size, the scale, the historic heft of Johnson & Johnson often have the luxury to move deliberately. But J&J's CEO states emphatically, right here, right now, inertia is not an option.
I think healthcare, it's going to advance more in this coming decade that we have advanced in the last 100 years. That we have a better understanding of the biology of diseases, and technology is now accelerating the process of discovery in a way that was unimaginable, before.
The world of healthcare is changing rapidly, and even the most established players have to raise their game to keep up.
Our decisions about where to invest are very important in to what extent we are going to be at the forefront of those trends or not. Where and how. Should we do it internally? Should we do it externally? Should we use third-party partners? What type of constructs we want there? That's where a CFO can help us.
Joaquin has talked about the kind of power of innovation over the next 10 years, how much it's going to change, how quickly it's going to change. How do you approach the job knowing that there's going to be so much potential change in the years ahead?
The world is coming at us faster than it ever has, right? The pandemic was a really good learning. We made faster decisions with fewer people, and that kind of mindset, I think, is very, very helpful. We're going to have to move faster. The competition's moving faster. The world is moving faster. We're getting information more quickly. We're getting more information.
CFO Joe Wolk understands the stakes. As the pace of change intensifies, CEO Joaquin Duato counts on him to keep the business on track.
One of his key characteristics is that he's somebody that is always 3 steps ahead in the game. He has an uncanny ability to see beyond the numbers and to be able to help the executive team, the entire executive team, think about how events may play out in the future and affect Johnson & Johnson.
I did read a lot of good analyst reports about the ASCO event.
We have the foundation of trust with each other that makes it possible for us to have different points of view and still have a constructive discussion. Sometimes I influence Joe, and sometimes Joe influences me. But we eventually get to a point in which we agree.
A commitment to change and innovation, guided and enriched by decades of experience. Johnson & Johnson's leaders believe this formula will lead to success.
I'm hard-pressed to believe that a CFO can be a generalist. Yeah, you can be a generalist and have a good understanding of the numbers, but to really impact the future of the company, you have to have a great understanding of the markets, the technologies, the patients, in our case, that we serve, and that's the way you can impact the future.
I inherited kind of a mindset with Johnson & Johnson Finance that it's been run as an organization under the motto of we're business leaders with a finance expertise. And so the strategic imperative is really to make sure that we continually innovate. Prioritization is always going to be the key. Matter of fact, what I say, the success to Johnson & Johnson, we have a plethora of really good options. How do we pick from those really good options and choose the great ones? That's what will dictate our success going forward.
J&J has transformed itself in the last 2 years. The company spun off its consumer health business, freeing it to channel strategic resources into innovative medicine and medical technology. It's a streamlining trend that's caught on across the industry.
If you compare the biopharma space with the consumer products space, the biopharma space is clearly the one where the money is and where the growth is. And the companies are shifting to growth because their investors expect them to grow.
And so you have pharmaceutical companies really fighting to maintain and achieve the most durable and highest growth rates. In terms of the risk that you take by doing this, if you have a profitable consumer healthcare business, then you lose a stability of cash flow, and then you also lose some stability of revenue stream.
To lose $3 billion of cash flow that was associated with the consumer health business is a tough day for a CFO, but it was the right thing to do.
Tying its fortunes to developing new drugs and devices positions Johnson & Johnson for higher growth. It also opens up higher risk from what's called the patent cliff, when a product's patent protection ends and generic competitors can enter the market. Bloomberg Intelligence notes that large pharma companies are exposed to billions of dollars in potential sales erosion by 2030 as patents expire. J&J's drop could be as steep as $15 billion.
What are you able to do as a CFO to cushion that fall when that happens, when you go over the patent cliff?
That cushioning, I think, begins years in advance, right, because of the long lead times of our products. The good news is we know years in advance when a product is likely to face that patent cliff. Investing in R&D, prioritizing R&D years in advance for that payoff that may happen 10 years down the road is critically important.
The number one priority in an innovation-based company is investment in R&D, and that has to be clear for everybody, and that's a clear mantra that I believe Joe and myself try to prioritize at every step.
J&J's top-selling drugs, including psoriasis treatment Stelara, face a projected $11 billion decline in sales by 2028. But it's developed new products, led by cancer therapy Darzalex, that are expected to more than make up that shortfall.
The innovative vision of the pharmaceutical business has one characteristic which is distinct. You need to renew your business every decade. And in order to be able to renew your portfolio, you are not going to be able to rely only on your internal R&D efforts. You also need to work with external innovation. And M&A is one of the tools that we use in order to onboard external innovation.
And this is where I really like our scientists because they're agnostic to the best science that's out there, right? So if they've got something in-house, but they see something outside of our walls that is better, they will advocate and say, that's better for the patient, that's better for the physician, let's go pursue that.
Johnson & Johnson has expanded its portfolio significantly through M&A, most notably in MedTech, where it spent nearly $30 billion to purchase cardiovascular technology firms Abiomed and Shockwave. Joe Wolk elaborated on the company's approach to making deals.
What's the right strategic fit? That is 80% of the conversation with our board of directors, with our management team. Do we have a scientific expertise, a commercial capability, maybe it's simply breadth and scale, that allows that asset to be more valuable in our hands than the current asset holder? Our acquisitions don't tend to be cost synergy based. A lot of acquisitions, I think, are usually done probably more out of need. The one thing as CFO that I've got a great advantage is I've never felt that pressure to say we've got to do it because we're filling some hole.
How are you identifying smaller acquisitions to make, targets in that space that might not be the marquee names or as expensive?
But we did 50 deals that totaled more than $3 billion cumulatively last year alone. Most of those were in the innovative medicine space because you have to have a lot of shots on goal to continue to fortify the pipeline and make up for the patent cliffs that you mentioned earlier.
It isn't simple to predict what the return will be on each of these investments, given the long time it may take to bring products to market. But Wolk shared the formula he uses to assess a deal's value.
We start with our weighted average cost of capital, and then we add what we call an adder, or a hurdle rate. And that's to compensate shareholders for the risks that we're bearing on their behalf relative to that asset. So if you take a phase one pharmaceutical product, that adder is going to be much more significant than, let's say, a product in MedTech that's already on the market.
With a AAA credit rating and a balance sheet flush with cash, J&J can keep leverage low as it puts capital toward deals of all sizes. That gives a CFO plenty of options.
I look at Shockwave. It wasn't all cash. You raised $4 billion in the debt markets.
We did.
Why make that decision? Why, especially when interest rates are higher, would you go that route?
Yeah, it's to maintain flexibility, and we have the advantage of borrowing at rates a little bit lower than most because of the AAA credit rating. But yeah, it's a balance. You want to make sure you maintain that flexibility so we're not foregoing the long term for just the short term.
One reason for the company to be cautious with cash is uncertainty over litigation costs. Johnson & Johnson faces tens of thousands of lawsuits over claims its talcum powder caused ovarian cancer and mesothelioma. It stood by the safety of its products and has proposed a multi-billion-dollar settlement with plaintiffs. J&J insists the overhang has had no adverse impact on its operations.
Keep in mind that those numbers will have to be paid over a 25-year period.
A long period.
So this is not affecting, as big as those numbers are, our financial capability and our ability to be able to deliver in all our financial priorities.
J&J's stock price has had its ups and downs in 2024, with investors showing caution while waiting for long-term legal clarity. Still, Johnson & Johnson has increased its dividend in each of the past 62 years. And Wolk, who used to be the head of investor relations, says Wall Street should feel confident about the company's future.
We continue to grow our dividend. We continue to invest at record levels of R&D. We continue to make strategic acquisitions that will shore up this business for the next decade or two. And having the opportunity to generate $18 billion in free cash flow with plans to improve upon that in the years ahead puts us in a very good position where we don't have to compromise our strategic values for potential issues like a talc.
I'm curious what your approach is to share buybacks, broadly speaking. How do you time them or think about when to do them?
I think you have to be opportunistic at times when you think your shares are undervalued to lean in and fortify investor confidence or just simply make a good return, right? That could be as good a business decision as some of the acquisitions we look at. And so it's always part of the conversation. It's not something that I would say we prioritize in our capital allocation matrix, but it is on the matrix.
Coming up, a journey to the intersection of technology and healthcare. Joe Wolk believes collaboration can drive more innovation as MedTech gains momentum.
I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that.
This is Bloomberg. Joe Wolk has worked at Johnson & Johnson for more than a quarter century, but the CFO's connection to the company goes back even further.
My dad worked on the factory floors, spent 26 years of the end of his career at Johnson & Johnson. Back in the 80s when I was growing up, it was, if you kind of threw a stone, you were going to hit a Johnson & Johnson facility. So you go to church services on a Sunday, you go to a Little League game that you're playing in. My dad would run into people that he met. These weren't just work colleagues to him, they were friends. My mom also was a nurse at a local hospital, actually a block and a half from this Johnson & Johnson headquarters, St. Peter's Medical Center, for more than 40 years.
Wolk studied finance and accounting at St. Joseph's University. He then took a brief detour from business, earning a law degree. J&J CEO Joaquin Duato sees traces of Wolk's legal education in his management style.
He has an ability to influence others, which is based on his use of the, I would call the Socratic method. Joe doesn't tell people what to do, but he asks the questions to get people into the place that he wants.
What are the lessons from law school that you've applied to your job now? What do you bring to bear from what you learned there?
Yeah, I think it's trying to see both sides of an argument. Believe me, I probably could have learned a lot getting my MBA, but I just think the value of how I approach my day-to-day work from the law school training is something that I'm extremely grateful for.
After law school, Wolk eventually found his way back to his roots.
When I was evaluating when I was going to make a career move, Johnson & Johnson was one of about 2 or 3 opportunities I had at the time. Actually paid the less, but because of that history I had with the company, I figured I'd place the bet and go with Johnson & Johnson. And I couldn't have been more pleased with the decision.
Now Joe Wolk is helping steer J&J into a new phase of its history, expanding the frontiers of healthcare by discovering drugs and advancing medical technology.
We've always talked about the convergence of MedTech and pharma. Can you have a device that carries a drug? And so that kind of convergence could become really important.
KPMG has said they expect the global MedTech market to be $800 billion by 2030, growing 5% a year. And some areas of MedTech are growing much faster than that.
J&J's MedTech sales topped $30 billion last year, and Wolk is excited about where the business is heading.
We are developing digital robotic capabilities where it's not just the robot doing a surgical procedure. It's garnering information from that procedure for your specific demographic or the patient's demographic, and then informing the next procedure down the road. Right? It's getting smarter. I would say it's starting to morph into personalized medicine, which we know will lead to the best outcomes.
How is the timeline different when it comes to MedTech in terms of inventing something and getting it to market?
Yeah, it's believe it or not, it's actually longer.
Longer?
Yeah, if you're going to have a profound impact in the healthcare space, platforms that are prevalent today, these took close to 15 years to actually have a presence and a gravitas, I'll say, in terms of its usage out in the marketplace. So it does take longer. There's a lot of incremental innovation that happens along the way in the space of MedTech, but those big home run hitters usually take better than a decade.
Innovative medicine and MedTech are run as separate business divisions, but in the culture of research at J&J, they interact.
If you look at some of the spaces that we're in today, specifically oncology, there is a lot of dialogue going back and forth. Eye health. We've got a vision care business, contact lenses, surgical lenses, but also back of the eye, retinal disease from a therapeutics perspective. So there's a lot of knowledge sharing. I think it's something that will position us extremely well as we talk about not only a continuum of care, but also a continuum of knowledge.
How much are you visiting labs like this one and talking to folks doing the research and the science behind what you're making?
It's important for me to have an understanding, but as I said during COVID, when I was asked about the vaccine development, they don't want the CFO answering the scientific questions, right? The scientists, as well as the commercial folks, are very good at identifying, hey, this is plan A, everything goes really well. We know not everything always goes really well, right? Everybody has a plan. As Mike Tyson said, until they get punched in the face.
Yes.
There's a lot of punches, right, that we have to endure, but we persevere, we go through. And again, making sure that a majority of our decisions are really good ones, advanced science. Even the ones that we fail on, though, there's still a learning that's involved.
The convergence of technology and medicine is driving innovation in both sectors, with scientific and commercial possibilities just beginning to come into focus.
I think if you look at it 10 years from now, probably the competitive set that we have will look very different. There are technology companies that want to get in the space of healthcare. I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that. Right now, technology companies don't have the healthcare knowledge. Healthcare companies probably don't have the breadth of knowledge they need for technology. If we can figure that out together with great minds from both sides, I think that leads to a much better place. A lower cost to society, people living healthier, longer lives.
Up next, the Inflation Reduction Act aims to bring down healthcare costs in the U.S. But J&J and its peers say these regulations miss the mark, and patients will pay the price.
I'd like to see a much more fact-based dialogue around the topic of drug pricing.
When you chill innovation and investment in R&D, then you have less cures.
Plus Joe Wolk's advice to aspiring CFOs.
Cut through the noise and figure out what your priorities are going to be. And that's a precious few.
This is Bloomberg. With a strong pipeline of innovative drugs and a medical technology division bolstered by some big-dollar acquisitions, Johnson & Johnson believes it's built a foundation for sustained growth. But along with its U.S. peers, it's bracing for headwinds in 2026 when provisions of the Inflation Reduction Act go into effect. That legislation mandates price cuts and sets regulations that the Congressional Budget Office estimates could reduce spending on selected drugs by $100 billion over 10 years.
So the Inflation Reduction Act, as we have commented, is something that is misguided, and it's going to chill innovation. And when you chill innovation and investment in R&D, then you have less cures.
I do worry about the long-term effects of innovation. I'm not worried short-term. We're going to continue to pursue the path. Again, we've got a stable of products that will offset any of the losses that we have for maybe a few of the products that are subject to that new regulation.
I think a company like Johnson & Johnson will be able to continue being successful in the context of the Inflation Reduction Act, but the number of medicines that will be there will be less, just because less investors would be putting money into developing new medicines. So I think that's the ultimate effect. It's going to be less attractive for investors to put money there. Fortunately, as we are globally diversified, and we have also the diversification of having medical technology and pharmaceuticals, is something that we think we can navigate better than any other company.
I think people really underestimate the amount of growth that we're going to see outside the US. And a lot of these companies are already at roughly 50-50 US versus OUS sales. That's where the patients are going to be, where a large percentage of patients are going to be. The payment and the amount of revenue you can generate is going to continue to grow.
Joe Wolk understands the need to rein in the cost of prescription drugs. He questions the way lawmakers are approaching the problem.
I'd like to see a much more fact-based dialogue around the topic of drug pricing. About 6 years ago, Johnson & Johnson, and I think this is emblematic of the industry, was paying about 25% in discounts and rebates off of list price. Today, that number, discounts and rebates, 60%. yet the patients aren't receiving the benefit of those discounts, right? We continue to invest heavily in R&D so that we can make an impact on healthcare for society. The middlemen are not making that same type of investment, and yet they're not passing on the discounts and rebates to the patients that they're supposedly serving.
CFOs like Joe Wolk, who have built deep industry knowledge and strategic savvy, are changing the perception of CFOs from number crunchers to corporate leaders. It's had an impact on the promotion pipeline. Over the last decade, the number of CEOs who came to the job directly from the CFO chair has risen from under 6% to over 8%.
I'm not surprised to see that trend. I see the CFO as the individual which is not only helping the executive team see through the corners and being 3 steps ahead as we discussed. I see also as the one that is going to, once the priorities are set by the executive team, make sure that we have the discipline to operationalize those priorities. I mean, one thing is to have priorities, a different thing is to execute on those priorities.
I think the future of leadership is evolving. One of the things that I like that's happened a lot recently at Johnson & Johnson Finance is folks have left the finance organization to go out and run different parts of the business. I think that's a great time. It helps me sleep easier at night as a CFO, knowing that, boy, I've got leaders in other areas that have a respect for financial performance, probably have a really good mindset around compliance, have aptitude to do analytics. So I think it's an interesting time where finance leaders and that analytical mindset transfers really, really well.
Whatever the future brings, Joe Wolk clearly enjoys the job he has and his role in one of the world's most eminent pharmaceutical companies. I asked him what he sees when he looks ahead.
What is the opportunity for Johnson & Johnson over the next decade that most excites you?
I think it's continuing to innovate, being a world-class MedTech company, being a world-class innovative medicine company, and then bringing those technologies in select spots together. And that uniquely positions Johnson & Johnson like no other company in the world.
What is the challenge for Johnson & Johnson over the next decade that might keep you up at night?
I don't think there's any challenge we can't overcome. I do worry about regulation on the industry. I think there's a misperception of just how important life sciences is. Some of the things that we talked about in terms of cancer 10 years ago as being a death sentence, let's take multiple myeloma, now is potentially going to be cured. That's what this industry does. We're making people healthier. And so regulation that's not well thought out, that is penalizing, that stunts innovation, I think is my biggest concern.
This is fill in the blank. The hardest part of being a CFO is you can't say doing interviews with reporters.
The hardest part of being a CFO. I'm so blessed to have this job. It's hard to come up with that. I would say it's prioritization. As I said earlier, we have a plethora of good opportunities. Some are really, really good. But as we strive for the great ones, sometimes those really, really good ones have to be left behind.
And lastly, what is the best piece of advice you could give somebody who's just been promoted to CFO?
Cut through the noise and figure out what your priorities are going to be. And that's a precious few. If you've got a laundry list of 5 pages, you're probably not set up for success. And people will come at you, especially if you're newly appointed, looking to provide their services, their ideas, their thoughts. Cut through that noise, figure out what the 3 to 5 things are that will make you and the organization successful.
I'm David Gura. This is Bloomberg.